Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 127, and in this episode we are reviewing the performance of the global markets during the 39th week of 2024, and that is from Monday the 23rd to Friday the 27th of September. And without further ado, this is your host Jamhuri, and together, let's dive right in. We kick it off in the United States, where the latest data shows that inflation moved closer to the Federal Reserve's target rate in the month of August, easing the path for future interest rate cuts. On Friday, the Commerce Department reported that the PCE index, that is the Personal Consumption Expenditures Price Index, which is the Fed's preferred measure for the cost of goods and services in the U.S. economy, this rose by 2.2% over the past 12 months, vis-a-vis market expectations of 2.3%, and down from 2.5% in July, and was the lowest inflation rate since February 2021. Excluding food and energy prices, the core PCE index was up by 2.7% over the past 12 months, up from 2.6% in July. Federal Reserve officials tend to focus more on the core data, which is a better measure of longer-term inflation trends. And moving over to China, where in an attempt to reverse the current economic slump, the People's Bank of China, which is China's central bank, announced on Tuesday that it would cut its reserve requirement ratio by 50 basis points. The reserve requirement ratio is similar to the cash reserve requirement here in Kenya and stipulates the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. By cutting the reserve ratio, the People's Bank of China is signaling its intention to ease monetary policy as it increases the amount of cash available for banks to on-lend to their clients. The Chinese central bank, however, did not indicate exactly when it would cut its reserve ratio, but said it would happen in the near term. In addition to cutting the reserve ratio, the People's Bank of China also said it would cut its 7-day repo rate by 0.2 percentage points. For your information, the repo rate is the interest rate that the central bank charges when it lends money to commercial banks. On Wall Street this past week, the Dow Jones Industrial Average climbed to a fresh record high on Friday as traders digested the latest data that showed inflation was indeed slowing down. Investors are hoping that inflation will continue to cool off, and this will give the Federal Reserve more confidence to cut interest rates even further, and in the process reduce the borrowing costs for both corporates as well as individual consumers, who are the key drivers of the US economy. Wall Street posted its third consecutive positive week as the 30-stock Dow hit an all-time high during the session and posted a closing record of 42,313. Meanwhile, the S&P 500 ticked down marginally to close the session at 5,738, and a 2% decline in NVIDIA weighed down on the tech-heavy Nasdaq Composite, which dipped by about 0.4% to end the day hovering around 18,119. All the three major averages extended their gains to a third week, with the Dow and the S&P 500 rising about 0.6% during the week, whilst the Nasdaq advanced by nearly 1 percentage point. In the government bond market, U.S. Treasury yields dipped on Friday after the latest data showed that inflation was slowing down and moving towards the Fed's target rate of 2%. The Personal Consumption Expenditures Price Index increased at an annualized pace of 2.2% in the month of August and comes hot on the back of the Fed's 50 basis point rate cut the previous week. Additional data published on Thursday showed that the U.S. economy remained strong as the final reading of the gross domestic product for the second quarter of 2024 remained unchanged at 3%. In response, the yield on the benchmark 10-year Treasury bond was down by about 3.5 basis points to close the week at 3.75%, whilst the yield on the policy-sensitive 2-year Treasury note fell by 5.6 basis points to settle at 3.56%. For your information, bond yields and prices have an inverted relationship, and 1 basis point is equal to 0.01%. In the commodity markets, the price of crude oil posted a weekly loss as the prospect of increasing oil supplies from Saudi Arabia overshadowed China's efforts to stimulate its economy. Oil prices continue to dip even as the conflict in the Middle East escalates. And despite the prospect for lower prices, a report released on Thursday showed that Saudi Arabia remained committed to increasing its production output later this year. Nevertheless, the dominant theme in the oil market remains the weak demand from China, which saw the People's Bank of China unveil a new round of economic stimulus measures. The U.S. benchmark West Texas Intermediate crude fell about 5% this week and was last seen trading at $68.18 per barrel. Meanwhile, the global benchmark Brent crude pulled back nearly 4% during the week and eventually settled at $71.98 per barrel. In the precious metals market, the price of gold was heading towards its best quarter in more than 8 years after hitting a series of new record highs in recent sessions, as the latest inflation data suggests that the Federal Reserve will continue easing monetary policy, and this in turn has boosted the appeal of this non-yielding asset. After last week's 50 basis point rate cut and with inflation continuing to slow down, the Federal Reserve is well positioned to continue cutting interest rates. The prospect of lower rates going forward has increased speculative demand for bullion, which is projected to rise towards $3,000. Additionally, the escalating tensions in the Middle East have pushed up the price of gold, which has gained about 14% in the third quarter of 2024 and is up by around 29% so far this year. The price of spot gold hit a historic high of $2,685 on Thursday before correcting slightly to close the week at $2,651 per ounce. We now change scene to the Kenyan financial markets, and as usual, we start by looking at the domestic foreign exchange market, where during the past week, the Kenya shilling remained stable versus the US dollar, and according to data obtained from the Central Bank of Kenya, the official exchange rate for the US dollar was quoted at 129.19 compared to 129.20 the previous week. However, in the interbank market, commercial banks were selling the US dollar within a range of between 131 to 132 shillings. The lowest rate was offered by both Bank of Africa and Stanbic Bank at 131.50, whilst the highest rate was quoted by I&M Bank at 132.30. Meanwhile, the sterling pound was priced at 172.62 and the euro was valued at 144.17. And on the regional front, one Kenyan shilling was changing hands for 28.58 Ugandan shillings and 21.05 Tanzanian shillings, and to the Rwandese franc, it was posted at 10.36. Over the past 6 months, the shilling has been relatively stable against the US dollar. However, that does not negate the fact that Kenya's underlying economic fundamentals remain extremely weak, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. Despite its relative stability, the shilling remains vulnerable to external shocks, such as an increase in oil prices due to the escalating conflict in the Middle East. Kenya needs to contain its uptake of additional external debt in order to avoid falling into a sovereign default, which could send the country into an economic tailspin that will take decades to unwind. On foreign exchange reserves, Kenya's usable foreign exchange reserves increased for the third week in a row and was up by a significant amount of $171 million to hit $8.02 billion, which is equivalent to 4.1 months of import cover. This level of reserves is now in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports and is further exacerbated by our ever-increasing national debt that has pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the liquidity situation in the interbank market remained adequate and was also supported through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the economy. The interbank rate, which is the rate that banks lend to each other on an overnight basis, this increased marginally by just 5 basis points to 12.75%, and this was up from 12.70% that was recorded the previous week. And in terms of volume, the average value that was traded in the interbank market decreased to 19.5 billion shillings, down from 26.7 billion shillings the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the 4.25% cash reserve requirement, this stood at 12.4 billion shillings. For your information, the cash reserve is a statutory requirement that specifies a percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 26th of September, and the central bank received bids totaling 20.9 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 87%. The central bank ended up accepting only 12.4 billion shillings, and the results of the auction were as follows. The 91-day rate dipped by 2.8 basis points to average out at 15.71%, whilst the 182-day rate fell by 2.6 basis points and came out at 16.58%. And the 364-day rate was a shade lower by just 1.3 basis points and settled at 16.79%. In the primary bond market, the Central Bank of Kenya, acting in its capacity as fiscal agent for the government of Kenya, is now inviting bids for its October bond issue, in which it is looking to raise a total of 30 billion shillings for the stated purpose of budgetary support. The central bank is offering for sale 2 reopened fixed coupon treasury bonds, both with an initial tenor of 10 years and whose terms and conditions are as follows. The first bond, initially issued in 2016, has 1.8 years left to maturity and a coupon rate at 15.039%. The second bond, initially issued in 2022, has 7.6 years left to maturity and a coupon rate at 13.49%. Both bonds are now open for sale until Wednesday, the 9th of October. And for your information, the interest earned on these bonds is subject to withholding tax at a rate of 10%. In the international market, during the week, the yields on Kenya's Eurobonds were on a downward trajectory, with a yield on the 7-year 2018 Eurobond decreasing the most by about 80 basis points as it dropped to 8.3%, down from 9.1% that was recorded the previous week. At the Nairobi Securities Exchange, during the week, the equities market recorded a mixed performance, with the NSE 10, the NSE 25, and the NASI gaining by 1.6%, 1.3%, and 0.7% respectively, whilst the NSE 20 declined by 0.7%. This takes the year-to-date performance to gains of 23.4% for the NSE 10, 21.6% for the NSE 25, 17.8% for the NSE 20, and 16.5% for the NASI. The market's performance was driven by gains recorded by large-cap stocks such as DTB Bank, NCBA Bank, and Equity Group, which increased by 5.5%, 3.9%, and 3.5% respectively. This performance was, however, weighed down by losses recorded by other large cap stocks such as Bamburi Cement, which declined sharply by about 27%, whilst Absa Bank and British American Tobacco registered marginal declines of 1.4% and 0.6% respectively. For your information, a stock market index tracks the performance for a select number of stocks and is used to determine the overall performance of the stock market. The index is normally calculated as the weighted average price of the stocks that make up that index. On Kenya's national debt, according to the latest data obtained from the central bank, Kenya's national debt as of June 2024 stood at 10.56 trillion shillings, and this was equally divided between domestic debt, which stood at 5.41 trillion shillings, and foreign external debt that was valued at $39.77 billion, which is equivalent to 5.15 trillion shillings. For your information, Kenya's debt ceiling limit was converted to a debt anchor that is now set at 55% of the country's gross domestic product, and given that our current debt to GDP ratio is estimated at about 70%, this means that the government is in breach of its own borrowing target. Up next is our topical issue, and this week we are looking at Kenya's financial constraints due to mounting debt. According to the latest report by the Controller of Budget, the State House and the Interior Ministry jointly spent about 4 billion shillings, which was over and above the approved budget for the previous financial year that ended on the 30th of June 2024. The report also highlights the country's financial constraints due to mounting debt, with loan repayments increasing by nearly 30% in the 2023-2024 financial year compared to the previous year. The original allocation to the Consolidated Fund Services in the 2023-2024 financial year amounted to 1.96 trillion shillings. This was later revised to 1.99 trillion shillings in the second supplementary budget. This amount of 1.99 trillion shillings represents about 45% of the revised national budget of 3.92 trillion shillings. For your information, the Consolidated Fund is the main government account where all revenues are collected, and debt repayment is the main expenditure item from the Consolidated Fund. The report from the Controller of Budget states that the increased allocation towards the Consolidated Fund in 2023-2024 was mainly attributed to a 30% increase in debt payment obligations. The report adds that the original allocation for public debt servicing in 2023-2024 amounted to 1.75 trillion shillings. This amount was later revised to 1.78 trillion shillings in the second supplementary budget and represents about 90% of the total budget allocated to the Consolidated Fund. The revised public debt allocation for the 2023-2024 financial year of 1.78 trillion shillings comprised of 850 billion shillings for interest payments and 932 billion shillings was set aside for principal payments. Meanwhile, the allocation towards servicing external debt amounted to 763 billion shillings, while that for the domestic debt was set at 1.02 trillion. 1.02 trillion shillings. 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 1.02 trillion shill And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share it with a friend and help to spread the word around. I really do appreciate your assistance in this effort. And for your information, the Market Color podcast is hosted by Buzzsprout, and it is also available on all the major hosting directories, that is Apple Podcasts, Spotify, and Amazon Music. Please consider subscribing so that you can be notified every time I publish a new episode. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourselves a blessed and fantastic week ahead. And remember, the secret to your success is determined by your daily agenda. Think about it. Thank you, and God bless.